Good morning, guys. I've been recommending for those of you guys that love to save. I don't know if you're putting in 20, 30, 40 bucks a month at a bank just to put aside instead of putting into a bank and actually losing. Each dollar is going to shrink down to 75 cents or 60 cents. Instead of doing that, my recommendation to you is to put that money into a life insurance policy, get $1 million coverage for 10 years, for example. And in the event something does happen to you, sickness, accident, you will collect $1 million. If nothing happens to you in the 10 years, like say if you get a 10-year policy, if nothing happens to you, you get all your money back. It's called return of premium. So instead of putting your money in the bank and watching it shrink, losing value, how about you put it somewhere where each dollar's turn into $1,000? It's inevitable, guys. We're all going to get sick. We're all going to get into an accident. It's just not a fault of your own. You could be the healthiest guy in the world and you're still going to get sick. The healthiest woman in the world and you're still going to get sick. You could be the most cautious person in the entire world, and somebody's mistake will create an accident that, wrong place, wrong time. But let's assume nothing ever happens and you outlive your policy, nothing, you don't die, you don't get into an accident, you don't get sick. Everything that you paid into that policy, you get all that money back. I want you guys to think about what I'm just saying right now. As Americans, all we do is just pay bills, pay bills, pay bills, pay bills. We're making a big corporation rich. We're not building any assets. We're paying the electric, we're paying the gas, we're paying the mortgage, we're making a car payment, we're making a house payment. And if something does happen to us, we lose everything. How about taking that little bit of money that you put into saving and park it into a life insurance policy? It's a term life policy. You could go 10 years, 20 years, 30 years, however long you want. The younger you are, the more coverage you can have. So how about turning each dollar into $1,000 by utilizing this method? And when you collect that money, it's all tax-free, guys. There's nothing out there that is tax-free. If you have $1 million policy and you happen to have a heart attack, that $1 million is available. You don't have to die. Those are called living benefits, which means if in the event you get sick, diabetes, heart attack, stroke, multiple sclerosis, whatever it is that happens, you can collect that money while you're still alive. Think about this, guys. My number's on the screen. Call me. Let's get you protected. This way you don't have to lose your home. Your children don't have to downsize. They don't have to change their lifestyle. Give me a call, guys. Talk to you.
Text ONE-LIFE to 330-577-3496 to get started today.
Living Benefits Life Insurance, how it works. People often ask, how do I get money from my life insurance if I get seriously sick? The answer is Living Benefits. They let you access your death benefit early if you're diagnosed with a major illness like cancer, heart attack, stroke, or other critical conditions. This money is paid to you while you're still alive, tax-free. Real-world example, you have a $450,000 policy with Living Benefits. You're diagnosed with stage 3 cancer. The insurance company offers you $365,000 now if you choose to accelerate your benefit. You can take all, some, or none of it. You have options. If you take the full amount, your policy ends, but now you have the cash to cover treatment, take time off work, and relieve financial stress. True story. Sharon Edwards had this exact policy. Less than a year later, she was diagnosed with cancer. She received $343,000 in less than 2 weeks. She used that money for treatment, beating cancer, and is now living a healthy life. Key points. You're still fully covered if you die. If you get seriously sick, you can file a claim and receive a cash offer based on your condition. Offers are higher for more severe illnesses. This is not a loan or something you pay back. Old policies don't offer these modern policies with living benefits, but they do. Insurance companies offer this because it's financially neutral for them, but life-changing for you.
Text ONE-LIFE to 330-577-3496 to get started today.
And potential losses due to higher interest rates. We will likely see more bank failures, or at the very least, some will dip below their minimum capital requirements. However, these challenges primarily affect smaller banks rather than the major financial institutions. The rapid hikes in interest rates have increased loan payments, which borrowers might not be able to afford, leading to potential defaults. A record $929 billion in loans is maturing in 2024, partly due to extensions of loans initially due in 2023. Regulators are proactively working with at-risk lenders, issuing confidential reports to ensure these banks raise their capital. By attracting private capital, the aim is to minimize bank failures. Many of these stressed banks may need to raise capital or seek acquisition by stronger banks, although mergers and acquisitions in the banking sector have slowed significantly. The stress on these banks can have substantial implications for the U.S. economy, especially for communities reliant on smaller banks. The U.S. banking system comprises around 4,600 banks, with about 4,000 being small or community banks. Collectively, these small banks hold assets comparable to America's largest bank, J.P. Morgan Chase, with $3.2 trillion in assets. The stress is shifting to community banks, which have between $1 billion and $10 billion in assets. These banks are likely to face significant challenges. The Claris Group analyzed 4,000 banks, focusing on those with over 300% of capital in commercial real estate loans and potential interest rate losses. Their analysis identified 282 U.S. banks at risk, with nearly $900 billion in total assets. Most of these are smaller banks with less than $10 billion in assets each, while 16 have assets ranging from $10 billion to $100 billion. Smaller banks play a crucial role in supporting communities, especially away from the coasts. Regional banks, about 130 in number, control just under $3.1 trillion in assets and are vital for smaller businesses, local governments, and nonprofits. Without these regional lenders, businesses may have to turn to larger banks, which might offer less favorable terms. Despite the stress, most banks are not insolvent, but are experiencing financial strain, which impacts their ability to invest in new branches, technology, or hires, thereby subtly hurting communities over time. For depositors, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000, ensuring that individuals are protected if a bank fails. Commercial real estate loans are a significant concern, as higher interest rates make loan payments more expensive, increasing the risk of defaults. Federal Reserve Chairman Jerome Powell has acknowledged the likelihood of some bank failures. The Federal Reserve has raised interest rates 11 times since March 2022, leading to significant unrealized losses on banks' balance sheets. These banks must manage their interest rate risks effectively. The Fed is cautious about future interest rate changes, but the stress on banks remains high. Stressed banks can either shrink to match their capital or raise new capital. Fortunately, the solution should involve private sector capital rather than government bailouts. Mergers and acquisitions, M&A, could also help stressed banks. For instance, New York Community Bank raised over $1 billion from investors, strengthening its position. However, 2023 saw a 40-year low in bank M&A with fewer than 100 acquisitions. Regulatory scrutiny on M&A deals has increased, making it challenging for banks to merge. Regulators are actively working with bank leadership to address these challenges. They aim to ensure banks raise capital, sell assets, and improve their financial health without causing systemic issues. While some bank failures are expected, attracting private capital and allowing M&A could reduce the number of failures. The current banking stress is different from the Great Financial Crisis, which involved significant bank failures. Today, the focus is on smaller community banks rather than the large interconnected banks that are vital to the economy. Even if a small bank fails, the overall economic impact is manageable. Ultimately, the goal is to support the banking system through private sector solutions, ensuring stability and reducing the risk of widespread failures. This situation will likely unfold over the next few years, with continued attention from regulators and efforts to bolster the financial health of smaller banks.
Text 1Life to 33057773496 to get started today.